Hey, this is Trader Travis and welcome to another video in our free training series. If you like to see the complete course, we have a 6-module web-based course on our website, learnstockoptionstrading.com. It's completely free. It's step-by-step. Takes you through the entire option trading process from start to finish. So if you want to review that course, just go ahead to that website. But in this particular video, what we're going to do is talk about an option's extrinsic value and what that is. It sounds kind of geeky, kind of like, scientific, but in reality, it's really simple. And then once we define extrinsic value, we're going to teach you why options are called wasting assets. You might have heard that before. People say options are dangerous because they're wasting assets. And then we'll, teach you a few tips on how to avoid this risk of an option being a wasting asset. You can't do anything about it being a wasting asset, but there are a few tips to kind of work around that. Now, what extrinsic value is, it's the dollar value that's placed on the remaining life of the option. And extrinsic value is also called time value. They're used interchangeably, so just keep that in mind. Now, if you've ever wondered how life insurance premiums are calculated, it's something like that. What life insurance companies do is they estimate how long they think you'll live on average, and then they put a dollar value to your remaining years, and that's how they come up with your life insurance premiums. And so think of a stock option like that. It has a set life cycle, and that set time before that option expires ceases to exist. A dollar value is attached to it. And so let me go ahead and pull up my option chain and show you some examples here. Okay, now I'm pulling up an option chain, and again, extrinsic value is the time value that's placed on the remaining life of an option. Now, the one major thing you probably need to be mindful of is that the more time value an option has, the more expensive it'll be. So what I'm going to do is pull up several option chains here. We have a September option chain. These options expire in about 2 days. And so let's just look at the September 755 here. It's worth about $5. That's how much you would have to pay if you bought that option. Let's look at the October ones. And so these options have 23 days until they cease to exist. They expire worthless and they're no longer tradable. Okay. Now that same option, the 755 strike, is actually a strike. This is a September 755 strike. This is an October 755 strike. And strike is exercise price. These are exercise price. And we cover exercise price and strike price in another video, so I won't go into it now. But if you can just look at the price, just the option with 20-something more days is now worth $21.70. So it's significantly more expensive than this one. Now let's look at the November ones with 51 days left over. These ones are now $27. And so what you can see now is that they're going up in price. And if we pull up December here and scroll down, we can see the Decembers are 33. The same strike, 755. So the takeaway lesson here is that the more time an option has till it expires, the more expensive it will be because it has more time value. And options are comprised of more than time value, intrinsic, extrinsic. You have like 6 different factors that makes up an option's price or premium. And extrinsic or time value is just one of them. And so if I come over here and I change this to this, it'll show you how much of this option's price is extrinsic or intrinsic value. Intrinsic value would be the real value it has. Like gold has intrinsic value. It has real value, not inflated, not theoretical value. It has real value. And so these options have some real value. So this one has 50 cents of intrinsic value and $6 of extrinsic or time value. You can see here these ones have 0 for intrinsic and only have a dollar figure here in the extrinsic column. And it's because out of the monies are only comprised of extrinsic value. The only thing they really have is time value. Think about it. If you understand what the definition of a call option is, this call option right here gives you the right to buy the stock for $755. So you would pretty much pay more for the stock because the stock is currently trading at $749 in the regular market. So you can buy it cheaper in the regular market. And so it has no value. Whoever owns that contract, it has no real value to them, no intrinsic value. But it has a cost here, and all that cost is essentially nothing but time value. So out of the monies are comprised of nothing but time value. Now, the reason options are called wasting assets is because as time dwindles down, as these November options dwindle down at 40 days, 30 days, 20 days till they expire, well, that time value, this value right here, remember, it's the dollar figure that's attached to the remaining life of the option. And so as that remaining life dwindles down, so there's this dollar figure. And so essentially, all things being equal, if this stock went nowhere in price and time just kind of kept ticking away, then this option price will dwindle down from $5 to $4 to $3 to $2 until it is essentially worthless. And that's why they call options wasting assets. Stocks, you don't have that problem. Like if I bought, a share of Google, I could essentially hold it forever, until Google filed bankruptcy or something like that. There's no time limit. I can hold it forever. If Google is still in business, when my grandkids are here, I could pass that stock on to them. Well, this option here, if I buy it, it expires in 2 days. And so I have to do something with it within 2 days, or else, I can't do anything with it. I'll lose all my money. And so one of the tips I can give you to kind of avoid that risk of wasting assets is give yourself plenty enough time. If you're buying options, always err on the side of caution. Make sure you give yourself enough time for the trade to play out. And that way you don't kind of get caught in this little time value crunch where you're sitting here and you notice that, the option days are going by, the option is losing money, and the stock really hasn't performed the way you want it to. Now, how much time you buy, that's a depends answer. It really depends on your strategy. We won't have time to cover that in this video. Now, this is option buying. Option selling is a little bit different. Option sellers actually like time value decay or time decay because an option seller will come in here and sell this option right here. They'll get $470 cash in their account, and they kind of hope that you don't do anything with this contract. They hope time value goes away because they'll get to keep that cash. Now, that's a whole nother story, a whole nother lesson for another day. But I just wanted to cover both the buying and the selling side. So that's essentially it when it comes to extrinsic value. It's pretty simple. Extrinsic value is nothing but, the dollar value is attached to the remaining life of the option. So that's it for this training video. To get more of our training videos and see our web-based course, just go ahead and subscribe to our YouTube channel or click on the link below, and then I'll take you to our website. You take care, and I'll talk to you soon. Bye.